Rich people don't live the way most people think they do. From the outside, it looks like they earn a lot, spend a lot, and simply enjoy a luxurious life. But behind the scenes, their financial system works very differently. One of the most misunderstood strategies they use is living on loans. To an average person, this sounds dangerous or irresponsible. Why would someone borrow money when they already have so much? The answer reveals a completely different way of thinking about wealth, money, time, and power. For most people, debt is something to escape. It represents stress, pressure, and limitation. Monthly payments dictate life choices, and interest feels like punishment. But for the rich, debt is not emotional, it is mathematical. It is a tool, and tools are neither good nor bad, they depend on how you use them. The foundation of this strategy starts with understanding the difference between income and wealth. Income is money you actively earn, usually through work. Wealth is money and assets that continue to grow whether you work or not. Most people are trained to focus only on income. They work harder, chase promotions, and trade their time for money. Rich individuals focus on assets. Assets are things that produce cash flow or increase in value over time. These include businesses, shares, intellectual property, real estate, and entire financial systems. When someone with limited assets takes a loan, it is usually to buy consumption items. Cars, gadgets, furniture, weddings, vacations, these things feel good in the moment but do not generate income. Over time, they lose value. The loan remains, but the value disappears. This creates a trap where future income is sacrificed for past spending. The rich avoid this trap by borrowing only when the borrowed money is used to acquire something that pays them back. They use leverage. Leverage simply means using borrowed money to control more assets than they could with their own cash alone. If done poorly, leverage destroys wealth. If done intelligently, it accelerates it. One of the most common strategies used by wealthy individuals is borrowing against existing assets instead of selling them. Imagine someone owns shares worth $10 million. If they sell those shares to get cash, several things happen. First, they lose future growth. Second, they may trigger capital gains taxes. Third, the asset is gone forever. But if they take a loan using those shares as collateral, they get access to cash while keeping ownership. The asset continues to grow, and no tax is triggered because loans are not considered income. This single concept explains how many billionaires fund their lifestyles without ever earning a traditional salary. They don't need to sell or work more. Their wealth works as security for cheap money. Banks compete to lend to them, not because they are kind, but because the risk is low. When you already have assets, money becomes inexpensive. Interest rates matter deeply in this strategy. The rich aim to borrow at rates lower than the rate of return on their assets. If an asset grows at 8% annually and the loan costs 4%, the spread is positive. Over time, that difference compounds. Even after paying interest, wealth increases. This is why rich individuals are often relaxed about debt while middle-class families panic, because the math is completely different. Taxes play a massive role in making this system work. In many tax systems, wages are taxed heavily, while asset growth is taxed lightly or deferred. Loan money is not taxed at all. When someone lives on a salary, every increase in income increases tax exposure. When someone lives on loans backed by assets, taxes can often be postponed indefinitely. Interest paid on loans can sometimes be deducted as a business expense, further reducing taxable income. This creates an unfair but legal advantage. Money earned through labor is taxed immediately. Money accessed through loans is not. This is one of the reasons why the wealthy appear to pay proportionally less tax. It is not always because of fraud, but because the system rewards asset ownership over labor. Another key element is liquidity. Wealth does not always mean having piles of cash. In fact, cash is usually the least productive asset. Rich individuals aim to stay invested. When cash is needed, they borrow against investments rather than liquidating them. This keeps their capital deployed while meeting lifestyle or business needs. This approach also protects long-term wealth. Selling assets is irreversible. Borrowing is temporary. Over time, inflation reduces the real value of debt, while assets often rise with inflation. This means that loans taken today may feel cheaper to repay in the future. Inflation works silently in favor of borrowers who hold appreciating assets. Psychology also matters. Most people associate debt with fear because they experience it from a position of weakness. The rich experience debt from a position of strength. They control the terms, choose when to borrow, and negotiate rates. Debt does not control them, they control debt. There is also a misconception that rich people constantly increase their debt without limits. In reality, disciplined wealthy individuals are extremely cautious. They understand risk deeply. Assets are diversified, cash flow is stable, and contingency plans exist. Borrowing is done conservatively relative to asset value. This is why financial collapses, though dramatic, are rare among truly disciplined wealth holders. A powerful example of this strategy is real estate. A wealthy investor may buy a property using a loan. Rent pays the loan. Over time, the tenant builds the investor's equity. Once enough value is created, the investor refinances, pulling out cash while keeping the property. This cash is then used to buy more assets. The cycle repeats. At no point is the original asset sold. Debt increases, but so does net worth. This cycle explains how some people appear to endlessly expand wealth without visible effort. It is not magic. It is structured leverage applied patiently over decades. The public sees luxury. The balance sheet shows strategy. Critics argue that this system increases inequality. They are not wrong. The system rewards ownership and punishes dependency on labor. But understanding the system does not mean worshiping it. It means recognizing how money actually works instead of how it is taught. For those without significant assets, copying the behavior of the rich without the foundation is dangerous. Taking loans without income-generating assets leads to disaster. The difference is not the loan itself, but what the loan is used for. This distinction is rarely emphasized in traditional education. The rich also understand time. Long-term thinking dominates decisions. Short-term sacrifice is accepted for long-term control. Loans are structured over decades, not months. This allows systems to mature. Compounding needs time, and impatience is expensive. Another quiet advantage is access. Wealth opens doors to private banking, structured finance, and customized lending products. Interest rates, repayment terms, and flexibility improve as perceived risk declines. This is why debt feels suffocating to one group and empowering to another. It is also important to understand that many wealthy individuals never aim to fully repay their debt in the traditional sense. Loans are rolled over, refinanced, or paid down slowly, while assets grow faster. The goal is not to be debt-free, but to be control-rich. Control over assets, time, and choices. Living on loans does not mean reckless spending. Most wealth-backed loans fund productive activities or maintain lifestyle efficiency. Luxury consumption is often a smaller portion of net worth than people imagine. The image of excess hides a framework of discipline. There is also generational strategy involved. Wealthy families structure loans so assets transfer smoothly across generations. Trusts, holding companies, and estate planning ensure that debt does not destroy inheritance, but instead preserves control. Loans can even reduce estate taxes in certain systems. At its core, this method challenges the traditional belief that debt is always bad. Debt is only harmful when it enslaves future income. When debt is backed by growing assets and strategic planning, it becomes a bridge between present needs and future wealth. Understanding this does not require admiration for the ultra-rich. It requires realism. Money follows rules. Ignoring them does not make them disappear. Learning them provides choice. The biggest mistake is trying to imitate outcomes instead of systems. Seeing rich people live on loans and copying the behavior without understanding the structure leads to financial collapse. The strategy only works when assets, discipline, and long-term thinking exist together. The rich do not borrow because they lack money. They borrow because it allows their money to work harder, longer, and more efficiently. Loans become a tool to avoid unnecessary taxes, preserve ownership, increase scale, and maintain flexibility. In the end, living on loans is not about debt. It is about leverage, structure, patience, and control. It is not a hack, secret, or shortcut. It is a system built on understanding how money, law, and time interact. Those who understand it may never become billionaires, but they will stop fearing debt blindly. They will ask better questions. What is this loan funding? What is the return? What is the risk? Who controls the terms? Because the real difference between the rich and everyone else is not how much money they have, it is how they think about money.